Welcome to our annual State of the Markets presentation. We're very happy you've tuned in today and look forward to sharing some important information with you. I'd like to draw your attention to these disclosures so I can keep the regulators and attorneys happy.
Today we want to clue you in on some of the data we're watching. Of course, we can't cover everything, but we'll try to touch on the most relevant factors. And while past performance does not guarantee future results, we'll focus on trends that may help give you a clearer picture of where we are and where we're headed. Here's what we're going to talk about today. Let's start off by putting last year's market performance into perspective. At the end of 2017, well-known analysts gave their predictions for the S&P 500's performance in 2018. All but one predicted the index would grow. As you can see, growth failed to meet the average projections. Although the S&P 500 rose for the first 3 quarters, it lost nearly 14% in the fourth quarter and ended the year down by 6.2%. This decline marked the index's worst yearly returns since 2008. The S&P 500 wasn't the only domestic index that struggled last year. The Dow lost 5.6%, and the Nasdaq dropped 3.9%. I know that these returns and last year's volatility may feel unsettling. As is often the case, the fundamentals can tell a different story than what first appears on the first surface. Today we're going to try to tell you what happened in 2018 and what 2019 may hold.
So why did volatility return to the market last year? And why did stocks struggle in the fourth quarter? While a number of these factors influenced 2018's performance, the following 4 details stood out. Trade tensions, interest rate increases, midterm elections, and yield curve inversions. Again, volatility returned to the markets in 2018. Despite the S&P 500, Dow, and Nasdaq reaching new highs during the year, all major U.S. indices finished the year on a down note. So what factors contributed to last year's turbulence? We broke down 2018's major economic events into 4 categories for a clear picture of how the markets performed. Number 1, trade tensions. International trade disputes dominated the headlines in 2018. Here are the key dates from the conflicts. March 23rd, the U.S. imposes a 25% tariff on steel and a 10% tariff on aluminum from China and other countries. April 2nd, China responds with tariffs on $2.4 billion worth of U.S. exports. Number 4, on July 1st, Canada places tariffs on $12.8 billion worth of U.S. goods. July 6th, the U.S. implements tariffs on $34 billion worth of Chinese imports. China responds on the same day with tariffs on $34 billion worth of U.S. exports. August 23rd, remaining tariffs go into effect on China's $16 billion worth of U.S. exports and the U.S. tariffs on $16 billion worth of Chinese imports. September 24th, the U.S. rolls out additional tariffs on $200 billion worth of Chinese goods. China responds with tariffs on an additional $60 billion worth of U.S. exports. On December 1st, tensions ease as the U.S. and China agree to a temporary pause on additional tariffs. Our second issue, interest rates. With a growing economy and robust job market, the Federal Reserve raised interest rates 4 times in 2018. Those rate increases happened on March 22nd, June 14th, September 27th, and December 20th. Midterm elections are the third issue. The U.S. midterm elections resulted in a Democratic control of the U.S. House of Representatives, creating a split in Congress. Here's how the markets reacted before and after November 6th. October sell-offs. The S&P 500 experienced its largest monthly losses in more than 7 years. November 6th, U.S. midterm election results tipped the power in Congress, limiting chances for major economic legislation in the coming years. The S&P 500 reacted by jumping 2.1%, the largest increase following a midterm election since 1982. Our fourth issue, yield curve inversion. When short-term bond yields move above longer-term yields, analysts call it an inverted yield curve. Though some analysts worry this may signal an economic downturn, the negative dip at the end of 2018 is likely a result of the Fed tightening its balance sheet. On December 3rd, the 5-year Treasury yield falls below the 3-year yield, the first yield curve inversion in over a decade. That same day, the S&P 500 drops by 3.2%. With these major economic events in mind, let's turn to the details.
International trade dominated the headlines and investors' attention this year as President Trump followed through on his commitment to cut U.S. trade deficits. In 2018, the imposed tariffs on billions of dollars of imports from around the world, including China, the European Union, Canada, and Mexico. In particular, the U.S. implemented a 25% tariff on steel and a 10% tariff on aluminum imports in order to strengthen the U.S. manufacturing. The move caused Canada, Mexico, and the EU to respond with their own tariffs on U.S. goods. President Trump also claimed that China's unfair trade practices led to imposing tariffs on $250 billion worth of goods from China. The back and forth between the U.S. and China progressed at December's G20 summit when the two countries agreed to suspend additional hikes and work to reach a trade agreement. Despite the headlines, trade talks between the U.S. and other countries have generated some positive results. By the end of 2018, China agreed to reduce tariffs on U.S. goods and continue talks towards a resolution. On the home front, U.S. manufacturing has added jobs since announcing the tariffs on aluminum and steel. U.S. trade relations with Canada and Mexico also improved as the leaders from the three countries signed a new agreement aptly named the U.S.-Mexico-Canada Agreement. The agreement opened Canada's dairy market to U.S. farmers and settled issues surrounding auto tariffs.
The Federal Reserve raised interest rates 4 times in 2018, moving to a range of 2.25 to 2.5% by year's end. These hikes are a direct response to the 2008 financial crisis, when the Fed lowered interest rates to zero in an attempt to stimulate the economy. Since 2015, the Fed has raised rates 9 times. According to Fed Chairman Jerome Powell, interest rate policy no longer need to support an already growing economy. Throughout 2018, the Fed cited continued economic growth when raising interest rates. Despite concerns from investors on international trade, market performance, and a possible slower economic growth in 2019, the Fed stuck to its plan. Still, news that the Fed revised the number of projected hikes from 3 to 2 in 2019 suggests it will continue moving forward with some caution. Not all bear markets have behaved the same over the years. As you can see here, there have been 11 bear markets since 1947. A bear market is defined as a 20% drop from the market's all-time high. In this illustration, we're using the S&P 500 index to represent the market. As you take a closer look at the chart, you can see that many of these bear markets were closely correlated to a recession. Many of you may have heard that a recession is defined as 2 consecutive quarters of negative gross domestic product growth. In general terms, that's correct. But the designation of a U.S. recession is determined by a committee of experts at the National Bureau of Economic Research, a private, nonprofit research organization that focuses on understanding the U.S. economy. NBER says, recession is a monthly concept that takes account of a number of monthly indicators such as employment, personal income, and industrial production, as well as quarterly GDP growth. So while negative GDP growth and recessions closely track each other, the NBER gives itself a little wiggle room with the actual definition.
As we mentioned a few minutes ago, in December, Treasury yield curves inverted, and we hadn't experienced this negative spread since July of 2007. So first off, why do investors care about yield curves? Essentially, when a long-term investment has a lower rate than a short-term one, a recession may be ahead. However, not all yield curve inversions are created equal. In early December, spreads between the 2 and the 5-year Treasury yields and the 3 and the 5-year Treasury yields were negative. By month's end, you could even earn more interest on a 6-month Treasury bond than a 5-year bond. So, is a recession ahead? Let's analyze the spread between the 2 and the 10-year yields, which is a clearer recession predictor. These Treasury yields did not invert, and as you can see in the chart, even when these yields do invert, that doesn't mean that a recession is imminent. Since 1978, after a 2 and a 10-year yield inversion, the S&P 500 grew for an average of 19 months and earned more than 22% in returns before a recession began. So we've looked at a few factors affecting the market performance in 2018. Now let's examine the headwinds and tailwinds that could affect the speed and trajectory of economic growth in the near future.
So if recessions often trigger bear markets, do we have to worry? Let's take a look at a group of indicators that help ground our predictions and data. This slide takes us back to late 2008. Here we see a group of 20 indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is a positive for the economy, We could call that a tailwind pushing economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on economic growth. Let's look where we were in December 2008. Here we see lots of red on the board. The economy is in serious trouble. The housing market is deep in the red, volatility is high, global economic outlook is negative, and business spending is dropping. Now let's look at where we were in January 2018. You see a lot more green on this board. The U.S. economic outlook is strong, consumer sentiment is high, corporate profits are growing, and we see many more positive signs. Overall, 17 of the 20 leading financial indicators reported positive or strengthening numbers. There's only one red area on the screen, geopolitical risk.
Here we are in December 2018. The majority of the speedometers are green, showing positive news for the economy. The only negative on the board comes from geopolitical risk. No surprise there. Ongoing trade tensions as well as concerns about Europe's political and financial health create potential for market disruption. The yellow gauges are areas where the analysts have some concerns. Now we're going to continue to watch for developments, especially over the next 3 to 6 months. Though there's clearly enough room for improvement in 2019, our economy does reflect strength and potential, especially when compared to 2008. Now, the past can't predict the future perfectly, and financial markets don't always act in concert with what we see on these speedometers. However, barring some unexpected shocks, we're confident that the U.S. economy has continued room for growth in 2019. Now let's dive a little deeper into one of those areas on the speedometers, the leading economic index. This measurement includes 10 components ranging from stock prices to manufacturing orders. Examined together, the data may give a clearer, less volatile view of where we are. The latest report showing a continuing yet slower pace of improvement. The index also indicates that economic growth should continue through 2019. As you can see in the chart, recessions have never started when the LEI is increasing.
So we know that the LEI is increasing and many speedometers are green, but we still have headwinds to consider. When we look at the financial markets in 2019 and beyond, the following details could negatively affect economic growth and stock performance. We also believe a number of tailwinds could continue to support economic growth. While the pace may be moderate, we may be late in the business cycle, positive signs still persist. You might notice that two items appear on both headwinds and tailwinds lists, monetary policy and housing. Why? Monetary policy is in a middle ground right now. Right now we're still in an accommodative position with the Fed is striving to support GDP growth and interest rates remaining relatively low. But the Fed is cautiously working to get back to a more normal policy. A misstep on this course could serve as a headwind for the markets. For housing, rates are still relatively low, the labor market is strong, and homes are affordable. Details that all signal tailwinds and growth. But increasing interest rates and a change in deduction caps could slow the gains and provide headwinds in the long term.
How do current equity values compare to historical averages? Let's examine this chart to see whether stocks are at fair value. First of all, PE ratio means the difference between a company's price per share and its earnings per share. So the higher the PE ratio, the greater the difference between what investors pay for the stock and what the company actually earns. So a high PE ratio means that stocks are relatively expensive compared to what they earn per share. If you look at the middle dotted line on this chart, you'll see that the average PE ratio is 16.1. In other words, over the past 25 years, stocks have averaged a price per share of 16.1 times their earnings per share. In the Great Recession, the PE ratio was far below the average line. In the dot-com boom, it was high above the average. For much of 2018, stocks were above average values, but by December 31st of 2018, the PE ratio had dropped to 14.4, below the 25-year average. Now this data tells us that stocks are currently at relatively low prices for their earnings. We've discussed 2018 performance and what economic factors may come into play in the year ahead. Now, let's get down to details. I'm sure you're all interested in hearing predictions for the markets and the economy in 2019.
Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little can also stifle expansion. In November, the Consumer Price Index for all urban consumers, or CPI-U, which excludes rural populations, increased from 2.2% from 1 year before, above the Fed's target rate of 2%. The less volatile core CPI, which excludes food and energy, also increased by 2.2% in the same time period. So what will happen in 2019? Although wages are increasing, analysts predict that inflation will stay at similar levels this year. If this trend continues, it should support the Fed's decision to continue slowly raising interest rates in 2019. On December 19th, the Federal Reserve raised rates for the fourth time in 2018. Currently, their target interest rate is between 2.25 and 2.5%. In its announcement, the Fed reduced its prediction for rate hikes in 2019 from 3 to 2. The markets expected the December rate increase, but many investors were hoping the central bank would provide an even more dovish view of the future. However, worries about financial conditions and the pace of rate hikes led stocks to decline after the Fed's announcement. Ultimately, it's important to remember that rising interest rates are a sign the economy is doing well. But what happens when interest rates rise? Let's check the chart. The orange dotted line represents 5% yield on a 10-year Treasury note. Now, look at where the green diamonds are. They're mostly clustered in the upper left and bottom middle. This arrangement shows us that when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, history shows us that we may be able to expect the markets to rise as rates increase as long as they stay below 5%.
With all the volatility we've experienced in 2018, many investors worry that a recession could be right around the corner. Now, technically speaking, 2 consecutive quarters of negative GDP growth indicate that a recession is occurring. If you look at this chart, you can see that GDP growth picked up last year. The late 2018 and 2019 numbers are projections, but they're also indicating positive growth for our economy. While the current estimates for 2019 are lower than 2018, they're still higher than the economic growth we experienced in both 2016 and 2017. So as of December 2018, the unemployment rate was 3.9%. This rate is slightly higher than the levels we experienced earlier in 2018, but still falls well below historical averages. With unemployment this low, wages typically rise in response. In this chart, the gray line is in unemployment and the green line is wage growth. The two measures are usually inversely related. So when unemployment goes down, people can generally expect to earn more. As you can see on the chart, wage growth is beginning to increase and move closer to its 50-year average. So while low unemployment and increased wage growth can be positive signs, they can also bring risks. If you look at the red vertical bars on the chart, you'll see that when we've experienced recessions. In the past, when unemployment reached a trough, the business recession was usually only a few months away. But this indicator can be easier to see in hindsight because unemployment levels can fluctuate during an economic expansion. So we're not saying that the economic recession is imminent, but we do want to share a balanced view that when unemployment is very low, what that can mean for our economy.
So, given all these predictions, what are the experts forecasting for domestic equities in 2019? Each year, various media outlets compile the S&P 500 price targets of Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 this year. Now, these targets aren't ours. They are what the experts are predicting. As you can see, their 2019 estimates cover a 670-point range from 2,580 to 3,250, proof that even the experts often have differing opinions. But while they gave a range of results, one trend is consistent. All the strategists are predicting that the S&P 500 will continue to rise in 2019. Of the strategists we've included here, their average estimate of 2,940 to 2,948 would be over 17% growth. These are unquestionably strong returns. Earlier, we looked at a graph of returns during each year of an election cycle. Interestingly, 2019's average projected growth is almost exactly the same as the 17.4% average growth seen in post-midterm years since 1950. Of course, as we stated earlier in this presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2019, and predictions at this stage are pretty foggy. However, these analyst perspectives show that for the most part, optimism still exists on Wall Street. We've gone over a lot today, but if you take away just one detail from our presentation, remember this: emotions have no place in investing. As volatility returned in 2018, some investors who grew accustomed to watching the market soar reacted with concern and fear. The truth, however, is that volatility is common, and 2018's numbers demonstrate a return to normalcy within the markets. Let's reference this chart of stock market performance since 1980. The average year has a 13.9% difference between its peak and low prices. Although 2018's entry-year decline of 20% is larger than the last few years, the S&P 500 has still posted positive annual returns in 29 of the last 39 years. While volatility may continue, other crucial data suggest the economy will remain strong. For example, the GDP will likely hover between 2 and 3%, and the unemployment rate should stay low. We expect 2019 to bring continued growth in the economy, but volatility in the headlines can unsettle even the most seasoned investors. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you make the most of your financial life.
So what can you do in 2019 to move towards your family's goals? Here's some action items. If in your life or personal situation changes, keep us in the loop. We want to hear about your important family events like births or deaths. We also care about health issues, employment changes, and any financial developments, like an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investing changes. These could be details like a shift in your feelings about risk or any concerns about market environment. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts that you can give to you and your family. We're here to talk through whatever financial questions, worries, or excitement that you might have. And our priority is always to help make sure you're making informed decisions and stay on track. Throughout 2019, we're going to focus on delivering the following action steps to you.
Thanks so much for your time
We want
today.
to keep, as you can
Keep you
informed through regular communication, manage your investments according to your personalized strategy, and stay on top of
more
changes in
information
the
and
market
timely
environment,
updates,
and make
please
prudent
follow us on
adjustments
social
where
media
necessary.
and
Contact us at any time. Look us up at www.dmi.solutions. We hope that you've enjoyed the details we've shared today. I'm Jeremy Dodd for John McPherson. This has been the State of the Markets.